Okay.
All right. So I'll be able to upload all the recordings, and you'll be able to watch the recordings. So I wasn't really uploading the most recent ones because of that problem, but now it's been resolved.
Okay.
Okay. All right. So today's session, or rather today's discussion, will focus on cost of goods, accounting for opening and closing inventories, counting inventories, valuing inventories, and international accounting standard number 2, which is on inventories. Mr. Ferdinand, do you know that part? Remember when we were solving that income statement, and then we had revenue, and then after revenue we had cost of sales. So today we are going to understand cost of sales in details. Okay,
Okay.
and we are going to understand everything regarding inventories, closing inventories, opening inventories, and also counting inventories, valuing inventories, and its international accounting standard, which is international accounting standard number 2, inventories. And this session will be recorded. Okay, Agnes, Mr. Ferdinand, thank you very much for joining. We'll begin just now. Agnes, can you now hear me? Can you respond? Okay, if you can't respond, I do understand. Maybe it might be your network, or maybe you are in a location where you can talk. I understand, no problem. Okay, but we'll just proceed. And in case you want to say something, you can send me a message on WhatsApp, or you can text it out rather WhatsApp. I think that's when I'll see it faster. All right. Okay. So firstly, let's talk about cost of sales. Cost of sales, the cost of sales. You know what sales is. Okay, sales basically means your revenue, okay, or your turnover. Okay, sales. Okay, let me just allow someone in. Hello, Natasha, how are you doing?
Hi, Leonard. How are you?
I'm fine. Okay, so Mr. James, how are you? Mr. James, how are you? Okay. All right. So, just like I was telling everybody, today's focus in this particular session, this open discussion, is on cost of sales. Okay, accounting for opening and closing inventories, counting inventories, valuing inventories, and international accounting standard number 2, which is also on inventories. Okay. All right. I'm going to give you an example first. Okay, you might have a situation. Maybe you've seen something like this. Maybe you saw something like revenue in a format. Okay, revenue. Maybe the revenue is like 20,000 kwacha, and then we say less cost of sales. Okay, and then we said maybe less cost of sales, and then we had opening inventories. Okay, let's say for instance, I'm going to explain this. I'm just assuming maybe you saw something like this. Maybe in your past paper, maybe you were doing some computations, or in the book, or in the manual. Maybe you actually saw it somewhere. Okay, and then we have maybe 2,000 on the opening inventories, and then we have purchases, and then purchases maybe we have 500, and then afterwards we less closing inventory, and then after seeing closing inventory, we get our cost of sales, of which the cost of sales will be subtracted from the revenue to get the gross profit. But today's focus will be on this. Okay, we know what a sale is. Okay, a sale is basically the amount of money we make when we sell something that we are literally trading. Let's say, for instance, we exchange inventory for money. Okay, that's what a sale is. And sales are credits. Okay, so if we're to look at it in a trial balance form, the sale will go to the credit side. If you sell something, it's credited to the sales account. Okay, if it's a sales returns, it will be debited to the sales account. So debits reduce the sales, whilst credits increase the sales. But cost of sales is an expense. Okay, but it's a direct expense, and expenses are debits. Okay, that means cost of sales reduce the sales. Let me just explain what cost of sales are. So when we talk about cost of sales, we are looking at the cost of making whatever you are selling available. Okay, the cost of the goods that you've sold. Okay, the cost of acquiring whatever you are selling. Let's think of it like this. Let's say, for instance, we are into a retailing business, and this retailing business sells shoes. Okay, sells shoes. This retailing business sells shoes. For us to sell a shoe, we need to purchase the shoes. Okay, this is an expense, but this is a direct expense, an operating expense. Okay, expenses that are directly linked to us making a sale or to the sales. So we need to purchase the shoes. And then if we bought some shoes last year and then we still had them in stock, we'll call them. Okay, by the way, when we purchase shoes, if you purchase shoes, the shoes represent your inventories. So shoes are what we call inventory. So inventory is just your stock. Okay, what you have already in stock. That's what inventory is. So if we purchase shoes, that's a purchases. Okay, and then that increases our stock, the goods that we have available in stock. Okay, so if let's say, for instance, we are starting a particular financial year, and then we purchased some stock last year. Okay, we purchased some stock last year, but we didn't finish selling everything. Okay, we haven't sold everything yet, so we still have some stock when we are starting our financial year. We call that opening stock or opening inventory. Okay, opening stock or opening inventory. But imagine we finish our year. Okay, we finish. Okay, let me, before we talk about what happens when we finish our year, opening stock. Imagine we buy more stock this year. That stock will be referred to as purchases. Okay, purchases, we are basically talking about us acquiring more stock for our retailing business. And then after we sell everything, what remains will be the closing stock, what we still have after we've sold everything. Okay, so cost of sales basically represents the cost of acquiring the goods that we have sold, the cost of acquiring the goods that we have sold. So cost of goods sold is the direct cost of producing or basically purchasing the goods that a company sells during a specific period. Okay, if it's in the manufacturing business, it can include things like purchase of cost of raw materials, direct labor costs for production, or manufacturing overheads. If it's actually production and manufacturing overheads, we are talking about non-specific costs that are neither labor nor materials. Okay, so for us to find the cost of sales, the formula is like this: cost of sales is equals to opening inventory, okay, plus I'll say net purchases, because I know certain questions, the way they might come, they might bring you, maybe they have a purchases returns, so meaning it will have to be subtracted, or maybe we have some carriage costs that will need to be put into consideration. Okay, so it's opening inventories plus net purchases minus closing inventory. Okay, so this is the formula: cost of sales is equals to opening inventory plus purchases minus closing inventory. This is the formula. That's it. No two ways about it. Okay, so this is the formula. So let me give you an example. Let me give you an example. We do a practical question. Okay, let's say, for instance, we have opening inventory. We have opening inventory as I'll put it as 5,000. Okay, let's say, for instance, we have opening inventory as 5,000 kwacha. Let's change this to currency. Okay, and then we have purchases of maybe 20,000, purchases of about 20,000, and then apart from that, we have closing inventory. We have closing inventory of let's say 4,000, and then the question says find the COGS, the cost of sales. Okay, so like I said, The cost of sales is the cost of goods sold. Okay, that's what it represents. COGS is cost of goods sold. The cost of acquiring the goods that you have sold. Okay. All right. I'm going to explain that in details when we look at International Accounting Standard number 2, inventories, to answer the questions on why we are only subtracting the cost of sales from revenue, not the entire cost of all the inventories. Okay. So imagine the year is 2025, okay? The year is 2025. So that means in January when we were starting our year, we had opening inventory of 5,000, okay? So when we were starting our year, we had opening inventory of 5,000, which is good because we have some stock to sell, okay? But apparently the opening stock wasn't enough. We're like, okay, we need to make more money. So how about we buy some more stock for us to resell? Okay, so we bought stock worth 20,000. So this is purchases. And also the valuation is at cost. But when I say at cost, I mean the cost of acquiring them from the supplier. Okay, and the same inventory, if it sells, it's the same inventory but it's at sales value, meaning now I have added the profit. So when I add the profit, that's sales value or market value, but when I leave it the way it was when I got it, that's at cost. So all these are at cost. Are you getting my point, Natasha? Do you get the difference between at cost and at market value or sales value? Natasha? Or Mr. James, you can respond. I was actually greeting you earlier.
Yes, are you getting me?
Yes, I can get you now.
Yes, I'm following.
Okay, perfect. Okay, Mr. Ferdinand, do you also get the difference between cost and sales value or market value?
No, I didn't get that.
Okay, so when we say at cost, we mean the supplier cost. Like for instance, if you bought, let's say for instance, you are retailing shoes, and then you were ordering the shoes at 50 kwacha one and selling them at 70 kwacha. The 50 will be at cost in your financials, but the 70 kwacha, your sales price with a profit of 20 kwacha, will be at sales value or market value.
Okay.
Yes, you get it now?
Yes.
Perfect. So we have purchases, okay? We have purchases. So purchases are 20,000. Like, okay, our 5,000 kwacha isn't enough. How about we order more goods for resale, okay? So we got goods worth 20,000. That means the total number of goods that we had during the year is, okay, we had goods worth 25,000. So this is the goods available. So the goods available is basically the goods available for sale. So in 2025, we had in stock a total of goods with a value of 25,000 kwacha. Okay? But what we are looking for is the cost of the goods that we sold. The cost, this is the total cost of all the goods for 2025. But what we want is the cost of goods sold, or the cost of sales, or the cost of acquiring the goods that we sold. So how do we do that? We subtract what is remaining. Okay? So we subtract what is remaining. So if we subtract what is remaining, that means the difference was sold. Is that making sense, Mr. Ferdinand? If we subtract what is remaining, that means the difference was sold. So we subtract the 4,000, which represents our closing stock, the goods that we still had in stock when we were closing our financial year. That means this will be the cost of sales. So the cost of sales will be the 25 less the 4,000. So the cost of sales will be 21,000 kwacha. Okay, that means the cost of the goods that we sold is 21,000 kwacha, but we might have revenue of maybe, we might have revenue of maybe we added a particular markup, okay, on the revenue. So the revenue might be 30,000. So we need to subtract cost of sales from the revenue, and then we get what we call gross profit. Gross profit is basically your business profit after you only account for your operating expenses, or when you compare your operating expenses to your revenue or your direct expenses. When you just compare your direct expenses, like your cost of sales, your production cost, or your manufacturing cost to your revenue, what you get is what we refer to as the gross profit. This is before you put into consideration any other business expenses, such as your wages, stationery, utility bills, rent. Okay? All right. So this is how you calculate cost of sales. So the cost of sales shows how much the company spent on the goods that were actually sold. Okay? This figure is actually very, very important in terms of determining the gross profit. Okay? It's very, very important in terms of determining the gross profit. Okay, so this is cost of sales, and this is how we calculate it. I don't know if right now you are getting my point or you do understand, but I always say this: things become way clearer if you solve a number of past papers. Okay, so the more we look at it and the more number of past papers we solve, it will become easy. Okay, it will basically be a part of you. That's just how it is. All right, so now let's focus on let's talk about accounting for opening and closing inventories. Okay, let's talk about accounting for opening and closing inventories. I believe I've already explained what opening and closing inventories are, but I'm going to explain them again. Okay, let's start with opening inventory. Okay, so opening inventory, it's abbreviated as OI. Okay, that's what opening inventory is abbreviated as. Okay, so opening inventory represents the stock carried over from the previous period. Okay, it represents the stock carried over from the previous period. So it's stock from previous period carried over. So this is an asset. It's a current asset at the start of the period. So let's say, for instance, you have a balance sheet. We'll actually get to learn about balance sheet as well in details, solve them, practice them. Okay, let's say, for instance, you have a balance sheet as at January. Okay, the opening stock will be part of the current assets as inventory. Okay, all right, and then we also have closing inventory. So closing inventory is abbreviated as CI. Okay, closing inventory is abbreviated as CI. So this is the stock remaining at the end of the period. Okay, the stock remaining at the end of the period. So this is an asset as well. It's a current asset, but it's a year-end asset. It's closing inventory, so it's going to be in your balance sheet, in your year-end balance sheet as a current asset. Okay, so it's a current asset and reduces COGS in statement of financial position. So financial performance or profit or loss.
Just a question, Mr. Ronald.
Sure, you can ask.
So on opening inventory, you said a stock from previous period carried over.
Yes.
So it comes to closing inventory, you said a stock remaining at the end of the period. So what's
Yes.
the difference here? What's the difference here?
Okay, all right, let me just give you an example. Let's say, for instance, we have a financial year the financial year starts on the 1st of January 2025, okay, and then ends on the 31st of December 2025. Okay, so the closing stock for 2024, the closing stock for 2024 will be our opening stock in January. Okay, so the opening stock represents the stock we had in January. Okay, so what we had in January will be the opening stock. And then after we sell, we buy more, we sell more. And then in December, when we close the year, what we will have will be the closing stock. Okay, in December. after everything happens. Okay, what will have will be the closing stock. And then this closing stock will be the opening stock again for 2026. Are you getting my point, sir? You are
Yes, yes,
starting a year, you have
yes,
opening stock.
I'm getting your
Okay,
point
okay.
now.
Okay, now you understand it?
Yes.
Okay, perfect. And they are both current assets. It's just that this one, you rarely see it in as a current asset in the financials because it can only be a current asset if it's if that particular financial statement is just starting. Like for instance, it's a January financial statement. But most financial statements are year-end financial statements. That's the reason why you only see closing stock. Because most of the time they'll say for the year ended, for the financial year end, they never really do for the beginning. They always do for the year end. That's the reason why you always just see closing stock. But sometimes a question might pop up, but it's not really like it's an actual financial statement. When the question pops up, they might give you, like for instance, a statement of financial position, a balance sheet for 2024, and then you are preparing some financial records for 2025. That means the stock there, the inventory will be opening stock because it was the closing for 2024. So it will be the opening for 2025. You get it. Okay, perfect. All right. So let us proceed. So let's talk about the journal entries of these stocks. Okay, journal entries. Okay, let's focus on the journal entries. Okay. Okay. Let's talk about the journal entries. So when we purchase inventory, okay, when we purchase inventory, when we buy inventory, this is what's going to happen. Okay, when we purchase inventory, this is what's going to happen. The inventory will increase. How is it going to increase? We are going to debit inventories. Okay, we are going to debit inventories and then we are going to credit either the cash account, okay, or the payables. Okay, we're going to debit inventories and we're going to credit either the cash account or the payables. This is double entry. There's something that I actually like talking about, Mr. Ferdinand. You probably recall this. Mr. Ferdinand, do you remember our dealer? This can help you to basically just make sure you are comfortable with double entry and what should be debited and what should be credited. I actually like talking about this one. Let me just put this here. Okay, so here we'll talk about debits. So these will be debited. So let me just make this bold. So these are debits and then all these are credits. Okay, so firstly we'll have our drawings. What's next, Mr. Ferdinand?
Expenses.
Yeah, okay, yeah, let me just use the letters first. Let's say D, E, A, and then this side I'll just put L, E, R. Okay, this is very interesting, by the way. Okay, let me just create some more space. So here we'll have drawings. And then here we'll have expenses. And then here we'll have assets. And then here we'll have liabilities. And then here we'll have equity, which also represents capital. And even retained earnings or anything that falls under equity. And then R is revenue. Like this, revenue. Okay, so we have drawings, expenses, assets. On the credit, we have liabilities, equity, also known as capital, revenue as well. Okay, so everything on this side is debited, everything on this side is a credit. That's dealer. So drawings represents the amount of money you get from your business for personal use. It might be in form of money or it might be in form of inventory. In inventory, let's say for instance, you're selling shoes and you get shoes from your business. That's an inventory drawings. It's a debit, okay? It also reduces your equity because it's a debit and equity is credit. And then a cash drawing is Imagine you have your cash balance in your bank account and then you get money for personal use. That's also a drawing, but it's a cash drawing. And then expenses represent the costs that your business incurs, the amount of money that you spend to run your business. Okay, the amount of money you spend to run your business. We have two types of expenses. Okay, we have operational and non-operational. We have direct and indirect expenses. I'll use those terminologies. Direct refers to expenses like cost of sales, the expenses that are directly linked to your business or your stock or whatever you are selling. And then indirect costs, we are talking about costs such as your wages for your employees, your supervisors, or your stationery. They're not really directly linked to you selling shoes. Okay, and then assets, we are talking about resources that you have in your business that have got a high probability of generating future economic cash flows or future economic benefits. We have two types of assets. We have current assets and non-current assets. The current assets, these are assets that you use up in less than 12 months. Whilst the non-current assets are assets that will take you more than 12 months to fully utilize them. Examples of current assets, we can talk about your inventories because you sell them, prepayments, you can talk about the cash in your account at the bank or the cash in hand. All those are examples of current assets. And the non-current assets, we can talk about machinery, like for instance, you're using a particular machine, your equipment, all those are examples of non-current assets. Okay? And then we have liabilities. Liabilities basically refer to your obligations or the owings, the amount of money you owe some other businesses. So these are credits. This means if you credit a liability account, you're increasing its value. If you debit a liability account, you are reducing its value. For instance, if you get a loan from the bank, you are crediting the liability account. But if you pay back that loan, you are debiting the liability account. Okay, but because you've paid back that loan, what will be credited is the cash account. Because when you credit cash, you are reducing it because cash is an asset, and for it to increase, it has to be debited. Are you getting my double entry the way it's working using dealer? Hello, team. Are
Yes,
we
I'm
are we
getting it.
here? Okay, perfect. And then equity represents the part of the business that actually belongs to the owner of the business. It represents the amount of money you put in the business. I'll give you an example. Let's say, for instance, you want to start a particular business that needs about 50,000 kwacha for it to function, for it to be operational, and you only have 30,000. If you have 30,000 in your pocket and then you don't have enough money, you go and get 20,000 from the bank. That means the 20,000 will be a liability as a loan, and the 30,000 will be equity as your capital. Okay, and the revenue basically represents your sales. If you are selling shoes, when you sell a shoe, the amount of money that you obtain or you get, that's your revenue. Okay, so you can use this for your double entry. You get to understand it every single time we get to solve a question, we get to practice, or we get to explain a couple more or a few more interesting things relating to financial accounting. Then this will be clearer and better. Okay, all right. So okay. All right. So basically, this is how we do the journal entries. If we purchase inventories, we debit the inventories account and we'll credit the cash or payables account. But if we sell inventories, that means we'll credit the inventories account. Okay. If we sell inventories, that means we'll get to credit the inventories account. The inventories account will be credited. Okay. That's in revenue at the sales value. Okay. All right. So now let's talk about counting inventories. Okay. So counting inventory basically means your stock taking or your stock counting. Okay. So you can do a physical inventory count. Okay. So this is basically done to verify the actual stock, to verify if the actual stock matches the accounting records. You can do this periodically. Okay, let's say for instance, you can count your stock at a particular period end, or it can be perpetual, where your stock is counted and updated continuously in your system. Okay, so what you can do, just a rough idea, you can freeze stock movement for counting. Okay, and then you can physically count all the items. You can reconcile the counted quantity with the accounting records, and then you might need to investigate any discrepancies if there's any. Okay, all right. And then in terms of valuing inventories, I'm just going to tell you the methods of valuing inventories, but won't necessarily explain them in details because you need to learn them, and we'll actually create time for them. They are part of the syllabus and everything. Okay. So in terms of valuing inventories, so inventories must be valued at either cost or their net realizable value. The net realizable value represents, okay, imagine this. If you were to sell a particular inventory, okay, imagine this. If you sell, okay, net realizable value is the difference between the sales price of inventory and the cost of selling that inventory. Okay? It's the difference between the sales price of, between the sales price of inventory and the cost of selling that inventory. So whichever is lower between the cost of acquiring the inventory and the net realizable value is what you're going to put as a valuation. So we have a few inventory valuation methods that we can use. There's what we refer to as FIFO, there's what we refer to as LIFO, and there's also weighted average cost. Okay, there's FIFO, LIFO, and weighted average cost. So FIFO means first in, first out. So the oldest stock is sold first and valued first. And then LIFO means last in, first out. This means the latest stock is sold first. Okay, although LIFO is not really allowed under international financial reporting standards, since we follow standards every single time we're doing this. And then we have weighted average cost, which means we are using the average cost of all the units. Okay, we are using the average cost of all the units. Okay, so these ones, these are basically more of subtopics on their own, so we're going to look at them in details a bit later. Okay, for now I was just touching the basically the top bits of inventories. So our last part, the last part that we're going to talk about is inventories itself. We have a standard in accounting, okay, which is International Accounting Standard number 2, which talks about inventories. So this teaches us how to account for inventories, how to account for our stock in our financials properly and legally. It focuses on two main things. That's the recognition of inventories and the measurement of inventories. Okay, it focuses on two main things. That's the recognition of inventories and also the measurement of inventories. So International Accounting Standard number 2 provides guidance on how to account for inventories. Okay, so there are a number of principles, like for instance, it gives us a definition of inventories. Okay, so it explains inventories as assets or current assets held for sale in production or for use in production of goods. Okay, assets held for sale or in production or for use in production of goods. Okay, and then there are a number of cost components regarding inventories. Okay, the number of cost components regarding inventories, like for instance, the purchase cost. Just give me a minute. Mr. Ferdinand, do you have a question?
Yes.
What's your question?
My question is on when you are selling inventory, you said you credit inventory account. Then I didn't get which account to debit.
Okay, so let's just put it in general. If you make a sale, okay, you're going to recognize that sale at the sales value. So it will obviously reduce your inventory, but the actual double entry, because it's revenue, is a sale, it's going to be credited to revenue. Okay, so as to increase the revenue. And if it's cash, the debit will be on cash. But if it's a credit sale, that means you credit revenue and then you debit cash. You debit credit receivables.
Receivables. Okay.
You get my point,
Receivables.
sir? Yeah,
When you say,
receivables. Yeah, yes, sir.
I'm sorry, you debit which account? Cash or receivables?
Yes, cash if it's a cash sale, and receivables if it's a credit sale.
Credits. Okay. That's what I wanted.
Okay, so in terms of cost components of inventories, we have purchase cost and we have conversion costs. So the conversion cost, this is if it's a manufacturing business, the cost of basically converting them, like the raw materials cost or the labor cost, and then the purchase cost. This is if it's retailing, you basically just order your purchases. Okay, so these are the costs that you're going to find under inventories. Okay, so this is basically the summary of inventories, and this is what you are supposed to understand in terms of what inventories are, what closing inventory is, what opening inventory is, and what purchases are. Okay, so this session was recorded, and like I said, this was an open discussion, an open session. Okay, we'll have plenty more sessions, practical ones, to make sure we get to understand a whole lot in terms of financial accounting. Otherwise, this is just the beginning. Do you have any questions regarding International Accounting Standard number 2, inventories, or on cost of sales?
Are you going to share the notes or maybe to just like this?
Sorry?
Are you going to prepare the notes?
I actually have notes already on inventories since we've been doing this for some time. So we have recordings, notes, and everything. We've been doing this for, I don't know, in a couple of years, maybe 3. Yeah,
So
for
maybe
number of
we'll share,
classes. So yeah,
we'll share in a group maybe.
yeah, we actually do have the materials.
All right then.
Okay, and also this session